Good morning, gang. It's Dave Littlejohn. We're going to go Amblin and ramblin today, or is it walking or talking, or I don't know, but it's the morning of, I think it's July 24th. It's a Friday, and as you can see, I made my way down to the river. I had, it's longer than it needed to be, let me tell you, but if you can stick around for the next 15 minutes, you're curious what I'm thinking about, what's going on in the market, and more importantly, how to discern what parts of the market are working and what's not, and how it may be relevant to you and your personal investment strategy. Stick around. And hey, look at that dramatic entrance. Well, good morning, gang. We're gonna do another one of our walking and talking episodes. It's been a while since I have done any kind of video at all, so we're gonna try this one. It's just out for the morning walk because there's nothing that evidences that you're getting older than waking up before the sun and deciding you need something to do. So you go for a walk, right? And then we all say, well, it's for fitness or to get steps on my watch or whatever it is. Anyway, I had a few things on my mind, just investment-wise, that I wanted to share with everybody. Also, in light of there have been announcements and so forth. The merger with our Salem ranch continues to go really well, and the team members are all settling into how we're going to be getting our work done together, and I'm really very, very pleased with the way that's all going, and quite excited about what that's going to mean for the future, because we get to bring new resources and other things to the, I guess, just to the business, which hopefully should translate to more benefit for all of our clients. Well, but that's another, like, a sidebar point to what's going on in the world today, right? And there is the markets are doing some very interesting things, and I wanted to discuss them. In particular, I want to talk about how do we know if our investments are they doing well, are they doing poorly? And there's something going on that I've mentioned it before, but I think it bears repeating, and that's why I'm going to talk about it just for a moment. And that is something that I don't think there's a real name for it. I call it masking, but it's something that happens within a lot of the tracking indexes that we use. Now, a tracking index, the way I'm defining it, it's something like the Dow or the S&P 500 or even the NASDAQ. These are all benchmarks that we use to track performance. And of course, performance is uniquely individual. It's personal, right? Your investment mix is not the same as somebody else's investment mix oftentimes, nor is your time frame. So everybody's circumstances are personal, but we have to have some form of measurement. So we'll use an index, and or just a blend of index. Sometimes we'll say, well, let's use a little bit of this one and a little bit of that one. We'll put them together. Whatever the composite performance is there, that is how we measure is what we're doing effective or not. And it's a standard practice. I think that really we need to do a couple things though for your personal investing, right? First of all, look at the bottom line. People get really distracted by their statements. Hey, I got a bunch of stuff in there. This one's going up, this one's going down. And I oftentimes hear people that will call me and say, well, hey, why don't we sell that one that's not going up? And I said, well, that does make sense. By the way, there may be a little road noise in the background. I'm gonna walk by the road here for a sec. If you look at your statement and all you find is, I got 10 things that are making money, but 2 of them aren't. We better sell those 2 things. I would say, well, careful, because not everything makes money at the same time, right? And if investing really is the long haul, then you don't want to get distracted by really short-term moves in the market. Now, if something continues to underperform for a while, you need to analyze, we call it your investment thesis. What's the reason you own it in the first place? And is that reason still valid? If the answer is no, then you look at selling it. But I don't advise that people make knee-jerk reactions. The only time that I think knee-jerk reactions, or what I will say pretty quick reactions, should be considered is when you have a material alteration instantly around an investment. I'll give you an example. Some years ago, we owned, it was like Estee Lauder or something like that. It was a cosmetics company, It was Avon. We had Avon in our portfolio, and they had an accounting investigation because they said, well, you guys had accounting irregularities. And all of a sudden, that stock and all of the assumptions that were built into it were questioned, right? Everybody said, wait a minute, if the accounting's flawed, everything we know about this is wrong. And the story completely changed in an instant. Well, we had to go in and do some pretty aggressive analysis, ultimately determined that we couldn't make a good risk call. So we ended up exiting that position. And when you do that, remember, that was in a portfolio that had 25 positions. So it was 4% of the portfolio, and we said, well, we can't make a risk call on 4% of it. We'll replace it. That's just risk management at that point. It could have been that Avon was a great investment, right? It turns out it did go down, so we were vindicated, but it could have been a great investment. Could have gone up and up and up from there. We didn't know, and so the way that you do analysis is around discipline, right? So, okay, it must be the morning commute for some, right? Anyhow, I use this as an important factor in how we're analyzing things, because I'm hearing people get pretty nervous, and understandably so. The media narrative and the news cycle really preys on our fears, and it preys to our emotions. There's a very good reason for that. I'm not going to turn this into a psychology episode. I'm just going to tell you that we respond more to fear, and so we get a lot of fear in the media because that's how humans behave. It's like, okay, well, the fear is what motivates me to do something. It also gets me to stare at it. So let's just table that for a minute, though. Let's go back to the indexes, okay? The indexes that we're tracking, here's my concern. They are, and these indexes, remember, they're the benchmarks that people compare for performance. They don't tell what I believe is a fair story of the total market right now. They tell a big part of the story because they've managed to go up, and most of, like the NASDAQ has actually, it's pulled back from its all-time high of just a few days ago, but it's higher than it was before COVID hit. So what's it telling us? Well, it's telling us investors are pouring money into technology and areas of the market that they think are going to survive in a world that has to endure this virus and all the politics that come with it. So that index is heavily concentrated in technology. Well, technology has been a favorite area. It's not always a favorite area, just so we're clear, but it has been for the last several months. So the NASDAQ's at all-time highs. Well, the S&P 500 is the one I really want to talk about. This index is tricky because it's supposed to be 500 stocks. It's actually like 505 stocks. And they change it from time to time as companies grow. It's supposed to be the 500 largest US headquartered stocks, right? So the 500 stocks are going to change as they shuffle around for the top 500. But here's the wacky thing. Like 5 of those stocks represent like 20-something% of the weighting of that index. I've discussed this before. I use the real estate analogy. It's like if you had the United States, you know, Texas is really big and Rhode Island is really small. Well, the S&P works like that too. The biggest companies get the most real estate. So if we were going to use a comparison to the way the index gets valued, it's more like the House of Representatives, right? It's represented by the population and the size of the state, where the Senate is not. The problem is if you have only 5, or in S&P's case, I think 10 stocks make up over 25% of the index weighting. 5 stocks maybe 20%, but it's crazy how concentrated a handful of stocks are in that index. If those stocks go up, then the index tends to go up. And if they go down, the index tends to go down. And these are giant companies. When you start to hear how big they are, it's Apple, Facebook, and Facebook's small, actually, comparatively. Google's in there, Amazon's in there, right? Microsoft's in there. I think between Microsoft, Google, Amazon, and Apple. I think all of those companies, if you were to take all the stock they have in circulation at the price per share of their stock, we call that the market capitalization, they are over $1 trillion each. That's bigger than most countries' economies, okay? Obviously not the biggest countries, but we have individual companies in this country that are bigger than some countries. So obviously, if you've got that kind of real estate occupied in your index, you're going to heavily be influenced by those handful of stocks. And that is the point that I wanted us to talk about today, is as we're analyzing our investments, how is our performance? But see, you can hear, right, the bridge behind me, there goes the big trucks. Hey, that's commerce. We like to see the economy working. Anyhow, we know that, or we can imply, I should say, we can infer that because the index is highly concentrated, that those companies are doing well, then everybody's doing well, right? Wrong. This is the part that's just, it's really something to me. We literally have portions of the market that are not working. If you look at tourism as an industry, if you look at airlines are still in a major struggle, energy companies, real estate, the financial sector has been interesting. It's sort of been up and down, but there are areas of the market that are really fragile. It makes sense, right? Real estate, we're in an environment where we don't know, we have huge high unemployment, and folks that we're nearing the end of July here as I'm writing this, we're at the very tail end of July. We have the stimulus and the unemployment benefits that were expanded are due to end. So, or there, you know, is an extra bump. So if those end, we do rent payments. Are people going to make them? And if they don't pay the real estate, what happens to the banks, right? If they don't pay the loans that the banks have on property. And so what does that do to the financial system? We don't really know. We know that the government printed a bunch of money in the form of stimulus and in the form of Federal Reserve bond purchasing. And if you don't know what that means, it's okay. You can literally just kind of say to your buddies, God, we just printed money. It's like, well, we did. We just made it up. And that money's going into the system in some places, but it's not equal, right? Cruise lines are not a place that they did have a bounce, but if we don't reopen the economy and we can't get people on cruises, those companies can't make money, then it doesn't necessarily end real well. So anyway, the indexes don't reflect that real well. I think they ought to, but they can't. So you have to look at other indexes. And there is probably if I had on this long-winded journey with me, what's the takeaway? It is you need to look at the market at large. And so know what your index is, right? What does it matter for you personally? But, and so what's the right performance? And that's tied to your investment plan. Okay, and if you don't have an investment plan, if you're younger, that's probably okay. Look, I'm just accumulating, and someday later we're going to sort it out a little bit more. But for a lot of folks, if you are closer to, if you're within 7 to 10 years of a potential retirement, then you would like to have, I think you should have, professionally, I think you should have a little bit better idea of what you're doing. You need to start targeting an outcome with your investment strategy. And if you're not doing that, then either it means that you just got so much that you don't have to worry about it, which that's great. But for most of us, it is, well, I'm going to need to figure out when am I going to use this and what's it need to look like. And then appropriately benchmark what you're doing to see if it's working. Because I will tell you that as much as the really big tech companies have been working, other areas of the market are not working as well. And you can see that in other indexes. If you look at value-based indexes, which is a different way of evaluating investments, the two big categories we talk about are growth versus value. Growth are companies that reinvest in the company. They don't pay a dividend to their investors. They buy more, they reinvest in the infrastructure of the company to try to get larger and increase their earning capacity. So they're investing for growth. Amazon's a great example. It's a huge $1 trillion company. They don't pay a dividend, right? The Amazon is still reinvesting back into infrastructure to get bigger, more trucks, airplanes, distribution centers, right? That's a growth-based story versus I'm not even going to think of. There's plenty of them, but the companies that pay dividends. But then there's other ways to. But value companies, they usually potentially pay a dividend, potentially, not always. But it's a different way to look at the balance sheet of the company. Value companies have really underperformed compared to growth. A lot of them are industry-based, but you get the idea. Is there are different ways to look at the market, and we need to do that. So my takeaway for the day, after all of this, if you've gotten to the end of this, is your personal benchmark matters, and you need to look at the whole market. Don't just get buried in the indexes. And beyond that, I'm going to try to post these more frequently. They're long enough that some of you are going to say, I can't watch that long. I don't blame you. I'll try to keep some of them shorter as well. That's what I got for you this morning. This was the walking and talking, or ambling and rambling, or whatever we want to call it. But I hope you can take a few nuggets away here. And again, sorry it was a little bit on the long side, but hey, stream of conscious this morning. So thanks for joining me on the morning walk. As you can see, we're down at the river's edge here. So I will probably throw the obligatory rock in because I like to splash, and then I'll head back. But until next time, gang, thanks for, if you're a client, thank you for your continued trust and allowing us to serve. And if you are not, if you somehow received this because you are either just watching YouTube or whatever venue that brought you here, and you were looking for financial advice, we always tell people, just because you're not a client or you may not become a client doesn't mean that we can't help you. Our goal is to help everybody make better financial decisions in their world. So thank you for joining us on the journey. I am representing the team. Thank you for joining me. Until next time, this has been David Littlejohn. You guys take care.